max fund an IUL to generate tax-free cash flow, or minimum fund it to maximize what is left behind when you die. In this episode, I'm going to address why an IUL is the most flexible insurance to meet estate planning needs. Get ready. I'm going to show you some things and give you insights that maybe you have not been aware of before. So I'm Doug Andrew, and I've been helping people with their estate planning now for more than 48 years. I'm sort of viewed as a financial strategist, a retirement planning specialist, and I've been so blessed in my career to have authored 12 books, and I have a national radio show. I have this YouTube channel, Three Dimensional Wealth. I would suggest that maybe you subscribe to this. It's free because I post an in-depth answer to a financial question almost on a daily basis. Now, in this episode, I'm going to talk about a unique little area called estate planning, where a lot of times people work throughout their lifetime and they accumulate a successful business or assets, and this is what we call is an estate. And so many times smart people will do some estate planning. They'll go to an attorney, they'll set up a trust, they'll have a will and a trust if they have assets they want to protect, because when you set up a trust, it has a lot of benefits that a will doesn't have. I have episodes on this channel that talk about the 5 or 6 major advantages that a trust has over just having a will. When people do this, they're usually trying to preserve their assets from all kinds of things that happen, liability lawsuits, from excess tax, if there's an estate tax, because that comes and goes at different levels based upon the federal government and who's in power with the president or the House and the Senate and so forth. But when people begin to realize, golly, okay, I'm going to pass away sooner or later, if you're in your 70s or 80s, you do not owe an estate tax on the first death thus far, only upon the second death. So usually your estate passes to your spouse with no estate tax and on the first death. But when the second spouse passes away, if you have assets over a certain limit, you need to file a 706 form with the federal government within 9 months. And if you go over the estate tax limit or threshold, then you will owe an estate tax 9 months after death. Now, a lot of times there are periods where the exemption can be millions of dollars, and so people don't worry about estate tax, but there are a lot of politicians, revenuers, where Joe Biden, at the recording of this video, has been entertaining lowering that down. We'll see what happens, because he is proposing that the estate tax, based upon whatever level, and he's even thinking about lowering it back down to $1 million again, that everything over $1 million that you leave behind would start out maybe as high as 40% and go up to as high as 67%. There have been times where estate tax started out at 37% and topped out at 55%. Let's just say that you want to maximize what you leave behind and minimize the taxes that you'll have to pay by having to liquidate assets. So many times we'll turn to life insurance as the solution, which is smart, because you're taking care of future liabilities for pennies on the dollar. So this is why a lot of times people will buy a life insurance policy, because you can pay premiums even though it may be, $10,000 a year, $20,000 a year. We've had clients that are worth millions and they'll pay $100,000 a year. Why? Because when they die, within 3 weeks, that policy might leave behind $5 million, $10 million, $20 million tax-free. They don't have to sell assets. I'm talking about the heirs. The children don't have to sell assets in a fire sale at a discount, which many times the IRS doesn't care if you're having to sell it in a quick sale, they say you owe tax on it because it's worth this. We don't care if you only got this much when you sold it. They don't care about that. So to take the pressure off, people will buy life insurance so they have the money to pay the estate tax if it's due without having to sell the apartments or the business or all the assets. Does that make sense? Well, that's about all they ever think about. What if you took some of the assets in the estate? Because many times I will meet with people and they have money that's sort of sitting in banks at a trust department at a bank earning 1%? Yeah, because the banks say, well, we have to be conservative. And so they're earning 1%. 1% on $1 million is only 10 grand a year. You know, a max funded indexed universal life policy usually will credit you between 8 to 10%, but some years as high as 16, 25%. In 2020, we had many clients for estate planning. They earned 61.33%. 850,000 grew to 1,382,000 for one of our clients in one single year tax-free. So why would you settle for a nominal measly rate of return of 1% where you're rowing upstream, so to speak, at 1 mile an hour in a bank, and the current of inflation in 2021, which is last year as of the recording of this episode, you're rowing upstream at 1 mile an hour, the current's coming down at 15, you're going backwards. Why would you do that? But you can maximum fund an IUL policy for great tax-free rates of return. And then when the insured dies, it blossoms and transfers tax-free to the heirs or the beneficiaries. Or you can minimum fund it. So I'll use an example to explain that. I had a client years ago that was 76, 77 years old. He had $500,000 in his IRAs. He came to one of my educational events, and he realized that he was never going to be in a lower tax bracket. He was in a 40% tax bracket, and he said, what am I waiting for? And he was going to have to start taking money out of those IRAs or 401ks at a faster pace. That's called a RMD, required minimum distribution, which is what his advisor told him to do. When he came and got educated, he said, you know, Doug, I'm just going to liquidate my IRAs and pay 40%. Yeah, that was 200 grand. He netted 300,000. What did he do with it? He could have put that 300,000 into a max funded IUL, and the death benefit would have been maybe 500,000 or 600,000, and it would have grown tax free. He goes, I'm never going to use this money while I'm alive. So let's maximize what I'm going to leave behind. Okay, so we took 300,000, put it into an IUL, and got 1.5 million of insurance. He died a few years later. Instead of leaving behind 500,000 in his IRAs that were earning under 3.5% return, he was able to leave behind 1.5 million tax-free when he died. Because the 500,000 in IRAs, his heirs would have had to have paid the tax on. They were only going to net 300 anyway. That's 5 times by using an IUL. So when you begin to look at an estate plan, you can have the flexibility with an IUL to use it to maximize what you leave behind, to earn tax-free rates of return while you're alive. You know what we do with our estate planning? We have in our family what we call a family bank. And every time the patriarch or matriarch in our family passes away, let's say with $1 million or $5 million of insurance is tax-free. If it's a $5 million insurance death benefit, we'll take 20%, $1 million, and fund another insurance policy on the next oldest, healthiest family member in the family. And now every time somebody passes away, as we go through generations, our family in our estate gets an infusion of tax-free capital. It keeps just going and growing, whereas most people, their assets deplete. And by the 3rd generation, it's gone. I have stories in my books that explain this. So if this is intriguing you, I want to gift you a copy of my most recent best-selling book. This is book number 11, and it's 300 pages, but it's actually 2 books in one. This one is 200 pages, 14 chapters with all kinds of charts and graphs if you're a left brain thinker. If you learn more by stories, you flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories. And if you want to use your whole brain, right brain and left brain, you can read both. But go to laserfund.com, LASERfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll fire out a hard copy to you, but there's also options there to listen and learn, watch and learn. There's even an 18-hour master class that you can learn about this if you want to do a deep dive. But also check out some of the online webinars and Retire by Design events, because this is about your brighter future. Share with somebody, post a comment, but subscribe, because this is about your brighter future.